So this presentation is about the double top and the double bottom technical chart reversal pattern. These patterns are formed at the end of trends and give traders a good idea that the trend has changed and a directional bias in which to position their trades. Okay, let's talk first about the double top pattern. So the double top forms at the end of an uptrend. The market's been trending higher. We get a pullback from a peak, which is labeled number one. Buyers come back in after the pullback, pushing the market up to the previous high, number one. Sometimes the market briefly goes through it. Sometimes the market may fall a bit short, but there's not enough buying pressure to really propel the market much beyond the peak of number one. So then the market starts to fall. Now, when the market closes below the previous trough, which is labeled Y, then we have completion of the pattern. So this tells you that the trend has reversed from up to down. So we certainly have a directional bias to the downside. Now, the good thing about price patterns is that obviously we have a directional bias, so we know which direction we should be trading in, but also we have a minimum price objective. And this is based upon the width of the pattern itself. So the width of the pattern is basically the highest peak, which is number two, labeled X, minus the trough at point Y. So this distance X minus Y is subtracted from point Y to give you point Z, a minimum objective for the double top pattern. Let's move on to the double bottom. So in technical analysis, what works on the upside should work on the downside. So double bottom pattern is seen at the end of a downtrend. So the market is trending lower. There are more sellers than buyers, resulting in a lower price. And then the market finds some temporary support at point one. We get a bit of a short covering rally. Now, as the trend is down, sellers come back in after the correction, and then the market heads down and retests the previous low. Again, sometimes the market breaks through it slightly. Sometimes the market may fall just short of it. But suffice to say, there isn't enough selling pressure to drive the market down as one would normally expect within a bear market. So what happens is the market bounces back up, and if it closes above point Y, this last lower high, then we have a double bottom pattern completed. So again, we have a directional bias to the upside because the trend has turned from down to up. And also we have that minimum projection based upon the widest point of the pattern. So in this case, it's again X minus Y, projected up from Y, which is the breakout point, and that gives you Z, which is the minimum projection based upon it. Okay, let's take a look at a few examples of double bottom and double top on a chart of dollar yen. Okay, so moving across to the CFI platform, we have an example here. This is back in 2016. So let's just go back here. So what we have here is a downtrend. Dollar yen is trending down, making lower highs and lower lows like so. And then it finds a bit of support around this 90, just below 99 level here. We get a bit of a bounce, and then the market tops out here just around 107.5, pulls back, has a retest of the low, but can't break through it. Then the market starts to bounce, but crucially, the market cannot take it, the trend through to new lows. We get the break above and close above the point X, and then the market has signaled completion of a double bottom pattern. So the minimum projection based upon this is 107.48 minus 98.93, projected up from the breakout point, which comes in around 116.03, which was easily attained fairly quickly here. Let's go back. Let's just take a look at a few more examples here. This is quite a big one, just a bit further back in 2011. So what we had here was dollar yen in quite a long-term downtrend here, making lower highs and lower lows. And then it finds a bit of support down here at 75 and 3/4 or so, 75.50, 65. Sees quite a bit of a bounce up here, 84 and change, and then pulls back, retests, has a go at the low, but can't push through the low, pulls a little bit short. Then the buyers come in, short coverers and buyers, and then we settle above the the breakout point, and that completes the double bottom pattern. So what we're looking at here is a move up to 92.75, which was seen again fairly quickly over the next few weeks. Going back even further, and there are lots of examples on dollar yen weekly, 3 on this particular chart. Let's go back to this one in 1998. So what we had here was dollar yen topping out at the end of a long uptrend. Initially, we topped out at 46.83, 146.83. The buyers came in, they pushed the market up to a marginal new high, 147.71, but not enough momentum to carry through. And then we started to see a bit of a shakeout because the buyers who bought the break are starting to panic out of losing long positions. The market then falls off quite sharply, closes below the breakout point, and that completes the pattern. So we have a minimum objective based upon it of 119.59, which was attained very quickly on this big break to the downside. Just looking at the other 2 examples, this downtrend based out at 101.26 back in 99. We saw a bit of a bounce, which took us up to 111.73. A retest, which didn't quite make a new low, based out, and then the buyers started to come in. And then when we closed above the breakout point, we had a situation where dollar yen targeted 122.20, and that target was attained on this particular move up. Last example to look at the end of that uptrend, dollar yen topped out at 135.19. We saw a sharp pullback here to 126.38. Buyers came back in, the market's responding to old resistance levels here. The market bounces back up, but again, doesn't quite manage to push that market through the highs. Tops out, eases back down towards the breakout point. We get the close below it, and this completes the double top pattern. And that gives us a target down at 117.57, which was attained just here. So you can see that the double top pattern and the double bottom pattern are quite common, and they can provide some very good clues as to which way the market is likely to go, and also to give you a target to shoot for if you are trading in anticipation of higher or lower prices. Thanks very much for listening, and the next one will come in the next week. Thank you very much.